So I'm going to start the recording now. I'll just briefly talk about GameStop before we move on to the normal coverage. So this is the discussion that we were having. It's an important discussion to have. This is why I tell you guys to keep tracking what's going on in the markets, because that's how you learn about the real world. At the end of the day, you have to operate in the real world, so you need to know how it works. And as you can see from this example, one of the good things that you learn from this example is that all kinds of crazy things can happen. So don't ever believe anybody who says that this can't happen and that can't happen. Anything can happen in the markets. Okay. So this is the question that Utsav was asking. You guys should read up on this, because you might be asked about this in an interview as well, because this has now become such a big story. So people might ask you in an interview as well. So better learn about it. And so I'll just point out to you, you can read about this. Short interest, this is one of the points that you should learn about, short interest. Short interest, basically this, they just talk about it as, so you need to know what is free floating shares. So if you go to Yahoo Finance or any other finance portal, if you remember the other day I was looking at FinViz, and in FinViz as well, there was this, I think there was this point about every portal will have the information about free floating shares. Free floating shares means essentially, it means the shares that are available freely for trading. So as I gave you the example, so Facebook shares, Mark Zuckerberg's holdings are not to be considered as part of the free float, because Mark Zuckerberg doesn't want his share to be going down, regularly. So he doesn't trade them, so they're not free floating. Okay, so that's what I mean by free floating. So you take the free floating stock. So you have the total number of shares outstanding. Out of that, you deduct stuff which are like stuff held by the owners and stuff like this Sergey Brin and Larry Page and Mark Zuckerberg, all their holdings. Deduct all that. Then you have the free floating stock, which is available for trading regularly. And then the short interest is expressed as a percentage of that, which is to indicate what is the percentage. So whatever is the free floating stock, this will be in millions of shares. And then you take, it is expressed as a percentage of that is the short interest. What that means is that 39%, so this is if, suppose the free floating stock was 100 million shares. So then 39 million shares have been sold short. Okay, borrowed and sold short. And so this is the point where I was saying that when you borrow stock, you'll notice on Interactive Brokers, they will first tell you, I need to check whether this stock is available for borrowing. You can't sell, you can't go short, you can't short sell unless you have, if you don't have the stock, and if you're having this, if you already hold the stock and you have a long position, then you're not short selling, you're squaring your long position. Okay. But when you short sell, you have to essentially borrow the shares. So short selling means you're selling something that you don't own. But in finance and financial markets in general, we should be at least theoretically quite comfortable. And this is the way we should think about things, that when we want to sell something, we borrow it and sell it. And we want to buy something, we buy it and put it on investment. Okay, so even if we buy gold and we put it on investment and see if we can earn something from the gold lease rates, etc. So that is the thinking in finance, the way you should think theoretically. Now, in certain markets, of course, there might be restrictions on borrowing and short selling. That's a regulatory matter. That is not a matter of finance theory. That is because the regulator has decided that you should not be allowed to do this. So, even sometimes you hear stupid things like it's un-American to go short. Nothing un-American about it. If you have a negative view on the stock, you should be able to go short. So you need both sides to make the market. So those are actually stupid statements. You might find people in India as well making those kind of statements. So that's what. So the concepts that we are learning are, what is the free floating stock? We've talked about this before, but I'm repeating that here today. What is the free floating shares? What do you understand by free floating shares? How do you normally talk about the short interest? This is a technical term, okay? Short interest. So it's talked about as percentage of the free float. And that means, as I explained, that what it means. And then, of course, that brings you to the idea that you're supposed to, if you're short selling, which means you're selling as your first transaction in that particular market, you are market instrument combination, and you don't have anything in your first position is a sale. So that's a short sell. And for that, you have to first borrow and then sell. Okay. So I might as well write this here. We may have discussed it somewhere. I'm writing it in general terms as asset instead of shares. Okay, we should not talk in everybody. Most people have this habit of talking in terms of everything is with shares. I want to learn about the stock market. I want to do this in stocks, or this is the number of shares. Generally, you should talk about in general terms assets. Shares are a type of asset. It's a species of asset. So we talk in general terms. So short sale is a start with the position, borrow asset, and then sell it. Okay, hope it fits in one line. Yeah, that's what it means. That's what short sale means. So obviously you have to borrow. So now notice something very interesting. This is a point that Utsav was also raising the other day. I think somebody else also mentioned it. Look at the information over here from 114% in mid-January. Now this should not be possible. Okay, this is a regulatory failure, and this is a operational failure at the broker's end, and the regulator should take action against this. You cannot sell stuff that you don't have unless you're able to borrow it. So this is, as I've said, this is why I wrote the statement the other day. Available for borrowing must be less than equal to floating stock. So if you combine this, okay, therefore let's combine this and say, now you know what short interest is, so I'm not going to define it by writing it here. Then I can write a few more. So this is almost mathematical. We are combining a few things. We are defining floating stock. We are saying that available for borrowing is less than equal to floating stock. Short interest is equal to less than equal to available for borrowing. Okay. So by definition, therefore short interest is less than equal to floating stock. So this has happened means that this is a problem. This should not happen. Obviously it's happened, which means somebody has, there are problems of bad delivery somewhere, or there is some kind of rollover permission being given. There is some kind of operational problem. This cannot be allowed to happen. This is a regulatory problem. The regulators should look. Maybe they are looking into it. I've seen this happening before. I've heard about this also in the U.S. markets, but this cannot be allowed to happen. Okay, this is not acceptable. This is not the way you do short selling, and therefore they should look into this. So this obviously shows you that even in the U.S. markets they have these kinds of problems. Looks like they have all kinds of problems now. So anyway, so this is what we learn. It's an important lesson to learn. So it's good that Utsav asked this question, because you have to know what's going on in the real world. And this is a big story. You might get asked in the interview, so you better read up on this. The other thing I would say is, so if you have any other questions similarly, so this is what I wanted actually. So when I've been beating up on you guys from day one, that you should follow the news. Actually, what I wanted is these kinds of discussions, that somebody should read something and not understand what, have some questions about it, then ask me, and then I would discuss it. You read something or you watch something on business television, and you get to know about the real world. This is something that should have been happening. I mean, this is the first time this is happening, or a few other times Siddharth has asked some questions, but this should have been happening a lot more often. But anyway, something is better than nothing. So this is an ideal kind of discussion that we should have been having for a long time. So, okay, what else do I want to? Okay, this is another thing. Just watch out for this site. Okay. Now, the normal Bloomberg.com, which I'd given you earlier, now that's gone behind a paywall, so you can't really watch much. Now, this BNN Bloomberg, this is the Canadian site. You can see .ca. So you can watch this actually because it's Canadian and it's very close to the US markets. So they'll have a lot of US markets news as well, and it's fairly good coverage. There's a lot of coverage. You can watch this as well. There's TV as well. But Bloomberg TV is available through YouTube, so that's okay. That's not been stopped. So you can monitor this, and then you can read these stories. Some of these stories will be illuminating for you. You can learn about stuff. So you can watch this other site. So you can bookmark this site. All right. So anyway, I've given you a link inside. So from there you can go. You don't need to write it down. You can read the story. Okay. So we're coming on now to today's discussion. Okay. We were talking about the previous discussion we had was on stack and roll, as you can see here. The discussion was on stack and roll, and we talked about how it works and what are the conditions under which you would run stack and roll, right? And so, but in any case, you need to know about what it means and how it works. So I have said stack and roll over here because to indicate the idea of a rollover, but please don't discuss it in the market with other participants as stack and roll over. It is just referred to as stack and roll, okay? So that stack and roll discussion happened in the context of our answering this particular. We were dealing with the decision problems because we had these problems in the case, right? I think we have this. So one of the problems in the case was, one of the questions was, how do the decision problems get affected when you're solving the active risk book decision problems? How do they get affected when you're running a passive hedging program? And so then we discussed all this, and that's how this question of why did I say active here for the buy sell, the extra decision problems related to buy sell, when you have to decide the expiry dates of futures contracts, when you're hedging with futures. That's active, and that's when that's the context in which the stack and roll discussion happened. Okay. So now next is entry price. This we have already discussed that it is active. This is in fact the real active problem that you have to solve because this is automatically solved at least at the base level, if not these. But this is the actual problem that you have to solve. So I'll just briefly. This we have already discussed. So what we can do is, since we are talking about, I think we started talking about the active and passive risk management programs in the previous class. Okay, let's read this here. This one is better. We can talk about this, and then we're gonna make this like 90% or something. Maybe even smaller. Yeah, okay. Close this. All right. Okay, so let's go to then. What we should do is now is that since we have talked about this, let me just briefly cover what's in the note with respect to this topic: static versus dynamic hedging programs. Because here, to make things simple, obviously dynamic hedging programs are much more complicated to even discuss. So to understand the basic concepts, we're trying to simplify the underlying situation. And we're saying that let's assume that we are running a static hedging program, although in your project, you'll be running a dynamic hedging program. Okay. On the subject of the project, please also, anybody else, please, just think about it. I am going to apply for, we're having some problems resetting the account equity. So I will be applying for new accounts for, we are running very late on this project, but can't help it. Our semesters are so tight, really can't do much. But I'm going to be applying this afternoon for new. I'm also not able to reset the account equity or send people invites. So I'm going to apply for new accounts for Ketan and Vipul. If anybody else feels that their account balance is very low, like maybe below 750K or something like that, please let me know quickly before 3 o'clock or something like that. And then I will add your name also to it for a new account. Okay. So if you don't need it, it's not compulsory, because in any case, it doesn't make a difference, because we are going to look at your total loss by looking at the starting value and the ending value. So whether you start with a high balance or a low balance, it doesn't make a big difference. But if your balance is very low, then of course you may have trouble putting on hedge positions. So that's why we need new accounts, at least for Ketan and Vipul. So please remember that as an administrative matter. We will do those first. I'll take the names administratively, those first, and then I'll go on to the capstone project problems. Okay, so let's quickly just come and see here what is the, let's cover the on this topic of static versus dynamic. Let's cover what's in the notes. Okay, what is in the technical note? Let's just check that, because we skipped over that. Right. And let's look at the types of hedging programs. Okay. So there's a lot of stuff here. I don't need to go through every. Yeah. So there is a. Yeah. Okay. So there's a problem that Srishti was having. Some of the links may not work, but as I said, you go through your student notes folder and then it should work. Okay. So some of the types of hedging programs, as we said, underlying exposure is always with respect to a market instrument combination, and it's always talking. So when I say what is the underlying position, the answer can only be long or short. Okay, and that's implied that it is with respect to some market instrument combination. So like, what is your underlying position in spot dollar yen? So the spot is the instrument and dollar yen is the market. And so the answer to that question would be either long or short. So now, yeah, so we are saying that hedging programs. So when you run a hedging program, you can either run it as a static program or a dynamic program. Okay. So as we said, this is a, I think I wrote somewhere here called hedge and forget, which is a term that you find in your book. Okay, which never mind. We can write that. I don't need to save myself so much work. We can write that once again. Okay, so we can talk about static versus we are covering this, so types of hedging programs. So we can write this in our session notes. So we had a session on GME, and then we go for types of hedging programs. Okay, is what we are discussing. So yeah, so when you run a static program, what it basically means is that when you do a hedge transaction, you never unwind this. So I'm not spending too much time on it because we have already covered it. I discussed it probably with you without covering the notes. Okay. Without going through the notes, and I'm just quickly going through the notes to make sure that we don't miss anything. Okay. So yeah, it is never unwound or reversed. Okay, the hedge position, this is the key part. The hedge position is never unwound or reversed before the underlying position runs off. Running off means what it means to run off is, as I explained to you the other day. So right now you see 2.5K ounces of gold on the books. But maybe after a couple of weeks, you have to remain as a hedging team manager. You have to remain in very close touch with the people running the business, which means you have to be in touch with the production team, and you also have to be in touch with the sales team and the accountants and everybody else on the finance side. So the sales team might inform you. Production team already put the inventory, the finished goods inventory on the books. And then the sales team might inform you that, okay, we sold this, we entered into a deal with Tanishq where we sold this and this will be shipped after 3 months. So shipping date is not important. That's like a settlement date kind of thing. So what is important is that they did a contract with Tanishq. And so unless Tanishq defaults, the market risk is now cleared. So this basically, as far as you're concerned, you're running an economic exposure balance sheet for a hedger as a hedging program manager. So as far as you're concerned, if they've sold 2.5K troy ounces to Tanishq, this thing goes to zero for your purposes, okay? So now if you had actually hedged by selling gold futures, when you came to know about this exposure maybe several months ago, and you were maintaining that gold futures position and rolling over the position as the maturity of each contract approached, and then as soon as you come to know from the sales team that this position has been sold and is no longer an underlying exposure, then you have to unwind, because so these guys have sold the position, but your short position in futures is still there. So now you have to unwind that hedge position, okay? Because now what has happened is, if you go back to you always have to look at the other day we were doing some total position calculations, remember? Yeah, so total position. So underlying position twice is 25, hedge position is 0. Now you go short 25 contracts. Now the total position goes to 0. Now if we make this, what happens here, okay, if we change, now what is happening is the underlying position is going to 0. It's quite terrible without centering. Yeah, okay. So now what's happening? The sales team is telling you that underlying position which you thought you had 25 contracts, we've already done a sale with Tanishq, so that position is no longer a there's no market risk on that anymore. Okay, it may be still lying in the mine, but it's already been sold. So this goes to 0. All right. So now what happens to your total position? Watch this. A total position is now gone to 25. Now, this will also bring us to the golden rule of hedging, but essentially you can't have this position. Now this thing has now become redundant. You can't have a total position below 0. I explained this rule to you the other day. Total position, if the UP is 25, if it initially goes to 25 and it is never changed, I'm just taking a very extreme kind of example to make you understand it, the principle. Okay, if once it goes to 25 contracts, underlying position, and it never changes unless it goes to 0 like here. Okay, so in this case, your rule is your total position has to stay between 25, which means you have not hedged at all, 100% unhedged, and 0, which is 100% hedged. These are the two extremes. Your total position cannot go beyond these two numbers. Okay, so on the plus side here and on the 0 side here, no negative. Total position negative, not allowed. Okay, so therefore, so on the other side, of course, if you have an underlying short position, that's it. We'll have to flip around the logic. Okay. But the point is, you understand what the point is, that you cannot, so now you can't run a naked hedge position without any underlying position. You have to now square this. So this has to be squared. So what you do is you close this position. So this is what is meant by a static hedging program. That here the running off means when you do the sale to Tanishq, the underlying position has run off. Okay, so therefore you need to unwind the position, the hedge position. Otherwise, you let it remain. Once you hedge it, so this is the hedge and forget. So this is what the Hull calls Hull Basu. We can say hedge and forget. Okay. So this is what he calls hedge and forget, because you hedge it and forget. So this is basically yeah. So the point to understand here is that this rule applies for a static hedging program, irrespective of what is the P&L performance of the hedge position. So if you go, let's say if you have here, if we go to gold, okay, so you see there's a slight break here on the S&P with all this turmoil. So it was going up here. If you zoom in here, you can see here there's a slight break. We should not, I have a tendency to discuss charts, but you can see this thing is broken. So very long uptrend, and now this thing you can see is broken. So there's a little bit of at least looks like at least one phase of the move from here, at least from here is gone. Okay, so now we should be correcting from here to here. You'll see a correction. We'll have to see how it goes. All right, so let's go to gold. So a little bit of a break on the S&P there with all this market turmoil. Let's go to gold and let's look at 240. And what was I saying about gold? What was the point that I wanted to make? Yeah. So let's say here, this is 240. Okay, fine. All right. So let's say that, so because your underlying position is long, so as a hedger, you will be going short. Okay. So let's say that you went short over here at 1755. Okay. And then initially you thought you were doing okay. And then the hedge position started to lose money because oil prices started rising. So if you go short at 1755, okay, and your underlying position already exists on the books, so your net position has gone to 0. The point here to understand is in a static hedging program, you don't really care even if the hedge position starts showing huge losses. because even the gold price goes to 2,000 and you're short on the hedge position at 1755. So you will show a big loss on 25 contracts, 2,000 minus 1755, okay, per ounce into 100 ounces per contract into number of contracts 25. That's the total amount of loss. So even though you're showing that loss, you're not going to unwind that ideally, you're not going to unwind that hedging program. Theoretically, if you're doing it the correct way, you're not going to unwind that program, because also remember something else, that although the hedge position is losing money, because of the dramatic rise in the gold price, because of the dramatic rise in the gold price, the underlying assets that you have, okay, and the underlying position that you have, the value of that is also going to rise. So if you have this one goes to 2,000, then if I put this as 2,000, look at the market value is 3.78 million, 3.8 million right now, and see what happens to the market value. It goes to 5 million. Okay, so the underlying position is also gaining value. Okay, I'm going to just go unwind this. So therefore, you are not concerned. You're not going to unwind the hedge position, because the underlying position is making profits as well. So your total loss actually is the losses on the hedge position are offset by the gains on the underlying position. Okay, but there is a cash flow problem here. Okay. Right, but we'll come to that. But the point to understand is ideally that let me just put a little ideally here, because it may not always be possible to follow this policy because of cash flow problems. Okay, so in practice what might happen is, okay, what we do is put an NB. So we have to note one thing here. Okay, so let's understand the theory first. What is the ideal theory? That even if the hedge position starts considered by itself, remember, when I said here that is losing money from here to here, that's only the hedge position. We forgot about the underlying position, which continues to make money. So therefore, the total P&L is actually locked in at this price. Okay, essentially it means if you do the calculations, look at the book that you have, look at your Hull Buzzard textbook. There are examples in that book, and you will see that essentially it locks in whatever price you hedge your total exposure at. That's your net realization price. Okay, no matter what happens to the market, you have locked in your realization or your sale price for that amount of underlying position. Your net selling price becomes the price at which the total position is hedged. Okay, this can be a weighted average price if you hedge it at in chunks instead of hedging everything in one shot. You may hedge it in lots, and then you take the weighted average hedging price. Okay, even if you're running a static hedging program. Remember, a static hedging program does not mean necessarily that you have to hedge everything in one go. A static hedging program only means that whatever amount you hedge, you never unwind that until the exposure runs off. But you can still decide to say hedge maybe 15% right now, and let's see what happens to the market. And then if it goes up a little bit more, then I'll hedge another 20%, and so on. That you can still do, and that still remains a part of the static hedging program. Okay. Remember here, a UP or part thereof is hedged. Okay, so that's what we're talking about, a static hedging program. Now, so the theory is that you never unwind the hedge position, even if it shows losses or even if it shows profits. Okay, so if you had, let's say, if you had hedged over here, okay, if you had put on a short hedge at this point, all right, and then the market started declining and it went all the way here. But here too, you would not unwind the hedge program in a static hedging program, because you would not unwind the hedge position. Why? Because the purpose of the hedge is not really to make money, it's to offset the losses of the underlying position. And remember, as you hedged over here and the market starts to decline, so the hedge position on its own shows profits. But don't forget that the underlying position, which is you have to visualize that the underlying position is being Mark to market, this stuff you have to visualize this balance sheet. I think it is written somewhere in your project brief, but this is how you should think about it. That this is being continuously mark to market. Whatever exposures you have, whatever be the underlying position, the latest dynamically updated position from the production team and the sales team. Production team is putting on the positions and the sales team is selling them off as whatever, whenever they can. So this whole thing is this, in real life, this figure is going to be dynamic, okay? In your project, we'll have to keep it static to make it manageable. But in real life, this is actually dynamic. So you take whatever is the latest updated figure at any point of time. So what was the point I was making? Yeah, I kind of lost my train of thought. But anyway, so the point is that, yeah, so you have to understand that you have to imagine that this balance sheet with the latest updated positions, this balance sheet is being like, just like your prices are changing constantly on these kind of charts, okay? Prices are changing constantly. You have to imagine that the balance sheet is being constantly updated with the latest market price, and the entire balance sheet is being revalued and marked to market at the current market prices for both assets and liabilities, wherever you have key risk factors. Okay, so all the key risk factor prices are being updated, and therefore the balance sheet is being revalued continuously. This is how you have to visualize it. Okay, in practice, obviously nobody's going to do that because it's not practical. So therefore, what is happening is, although you're in this case of the example of the profit on the hedge position, the hedge position is making a profit by selling it here, short hedge, and then it goes over here. The market is over here, so you're making this money, but the underlying position is losing money, okay, because the underlying position was last marked to market at this point, and it is being continuously marked down, and then it comes here. So the offsetting, so the profits on the hedge position are offset by the losses on the underlying position. So therefore, you don't unwind the hedge position just because you have a profit on the hedge position. So the goal of hedging is not to make profits, but it's to bring certainty to cash flows, okay, and reduce risk. So that's basically the idea. So whether you make profits, so basically this is the idea of a static hedging program. You never unwind the hedge, and even if it's a part hedge, whether you make profits or losses. Now, there is one problem, okay? This is you have to be aware of this, that okay. So the point here is that this is when you make profits here, you have to imagine that the balance sheet is being continuously revalued. So if it goes to 1800, you have profit. But this is a kind of a inventory revaluation profit. It's not a cash profit. You don't realize a profit. It's an accounting profit, okay? So these are not realized gains. These are accounting gains which are shown on the balance sheet, okay? If you have an economic exposure balance sheet, that is what you should be doing conceptually. You have to pay attention to accounting gains, but they have to also understand these are not cash profits because you haven't really sold this, all right? So, and you haven't realized the sale proceeds. So therefore, these are inventory revaluation profits, or sometimes could be losses. But even when they're losses, they're not cash losses, all right? So this is something you have to understand, that usually this is the case. That's why I put the word usually, because there could be some freak cases where there are realized P&L, there is realized gain, P&L on the underlying positions, but generally not the case. Okay, so I put in a little hedge statement for myself by saying usually unrealized. Okay. Let me copy the hedging program. Why write all this stuff? Uh, So many hedging programs use futures contracts, okay, because they also use forwards, but futures are a very popular tool for hedging because futures are very liquid. Many of the leading futures contracts extremely liquid. Okay, so therefore it's very good, very. I mean, it's a favorite contract for many hedging programs. So many hedging programs use futures. And not exactly great English sentence construction, but we just won't worry about that right now. What I'm trying to say is, whenever you use futures contracts, uh, the hedge position here, there's no usually business, always true. Okay. Okay, let's keep that in. Yeah. So you have to understand this problem. Okay. There is a little bit of a problem, although we are using the hedge position to offset the gains and losses on the underlying position. There is a little bit of a problem here. You will see even in the Sheldon Nattenberg book on options, Nattenberg talks about something like this. If we didn't cover it as part of our syllabus, but I think I refer you to it, which is, if you check those lectures, you'll see I'm referring to it, where he talks about stock type settlement versus futures type settlement. Stock type settlement is where you're basically fully funding the position. So there's a full cash flow involved. So the cash flow differences, he's talking about cash flow differences. When you're dealing with two different instruments and you think you're hedging one with the other, but there might be some cash flow differences in how the instruments function. Okay, so if one is a fully funded kind of position, whereas other is a margin position, there will be cash flow differences. So you have to watch out for that, because in real life, cash flow matters. Okay, if you have cash flow movement on the left hand, but there's no cash flow movement on the right hand, and you're trying to offset one with the other, there isn't going to be a perfect offset. So this is something you have to understand, that the UP unrealized gains normally, futures, if you're using futures to hedge, there is no usually business. This is going to be realized every day. Whatever the PNL is on the hedge position, if you're using futures, will be realized every day. So one of the things that can happen is, if you're running short hedges in a market like this, okay, imagine in a market environment like this, where you're running short hedges, and gold has been going up for a long time actually now. So if you're running a short hedge, which many gold miners will have, okay, because they don't know that it's going to happen to the gold price, it's going to keep on going up. So when you're faced with this kind of a situation, and these miners will have very significant, gold mining, very significant futures positions. Now their hedges are all short hedges, so they may have sold futures contracts, gold futures contracts, and those contracts, as the gold price is going up, those contracts are going to be showing large losses. But their underlying positions are not making, and these are cash losses. They have to be funded. This is something that I referred to, I think, in the discussion with Siddharth in the previous class, that the cash losses have to be funded. Okay, so whenever you have cash losses, like in futures, because every day you have to pay up if you have losses, and you'll also get to take money home if you have gains. But here there's generally a trend of losses for a short hedger. So this money, at some point of time, this can get to be quite a lot of, this is quite painful for a lot of companies, because nobody has this kind of free money lying around just to be funded, just to use it to fund futures hedges. Okay, this can be a real problem in many cases. And there are some cases where hedging programs had to be shut because of losses on the futures position. This is real stuff where you're losing money every day. You have to send the check to the exchange clearinghouse every day. Otherwise, they'll close out your position. So this is a serious problem that can come up for many companies, which is one of the reasons why many companies, many countries, like Mexico has a very famous, very well-known oil hedging program. Mexico tends not to use futures, but they use options. They buy options. So when you buy options, okay, there's a one-time cash outflow, but there is none of this business of day-to-day dramatic losses, changes in P&L, and you don't know how much money you're going to have to eventually put up. So what Mexico does is they spend a few $1 billion on buying oil put options. So then that's it. They don't have to worry about the cash flow anymore, because if oil prices go down, they'll have profits on their oil hedge. And of course, the underlying Pemex, Petróleos Mexicanos, the oil company, they will obviously have to be selling their oil at lower prices, but those losses are made up by the gains on the futures, on the long put option hedge position, which Mexico has put on. Okay, so we should mention this here. So the gains, since many hedging programs use our gains are so in practice, therefore, again, not great English sentence construction, but this is not an English class. I need to make the point and you need to understand it. Okay. It may not be possible to adhere to the ideal policy referred to above, because available cash to fund losses on futures HP may not be possible and may run out. Okay, so I gave you the example of may run out. Okay, so you have to understand this. So this kind of a problem can happen not just in a short hedge. Here I gave you the example of gold mining companies putting on a short hedge and experiencing losses on the futures contract, which are cash losses which have to be funded on a daily basis. And on the other hand, the compensating gains, there are accounting gains on the underlying position. So the accountant has no problem, but the banker has a problem because cash flow is draining out every day. So there is a problem, and therefore, ideally, as I said, although yes, ideally we would follow this policy and we never unwind the hedge, but in practice, sometimes you may get into problems because the cash, you just don't have enough cash to fund the losses on the futures hedge position. This is a serious problem. There is a case called, I'm going to write this thing. There's a case called MG Refining. If you are interested, I will. There is a Wharton case actually on this, where they have discussed these events. So I can share that file with you. It's a public domain document. Example, MG Refining case. All right. Now that was a different kind of case. So it's important to understand that this kind of a problem, okay, where you are forced to close the hedge position because of losses on the futures hedge. This can happen. Here I gave you the example of gold miners and a short futures hedge. This can also happen in the case of a long hedge, a long futures hedge. All right. So in this case, this story that I'm talking to you about, which is, let's look at the long-term chart. See, oil is going up. Okay, this happened, I think, somewhere in 1993. Okay, I was already in the market. I heard about this story actually somewhere around here, maybe Jan or December. I'm not sure. Maybe sometime around 1993. So it's a very small movement actually when you compare it to the dramatic movements on the oil price chart. But basically, this was a period of declining prices. You can't really see it very well here, but there was a period of declining oil prices. And so what happened was this company had sold some physical, oil contracts to many of its customers. It was in the business of providing oil and oil derivatives. And it had hedged itself by selling futures contracts, oil futures contracts. and some other gas, oil, and I think some other oil derivatives. There are many futures contracts on the CME. If you see, there is a futures contract for heating oil. Okay, these are all oil derivatives, which means you distill the crude oil, and at different temperatures, different stuff comes out, like kerosene comes out, then heating oil comes out. These are different temperatures. So these are all derivatives of crude oil, which means the prices are connected to crude oil. So they hedged everything by selling short crude oil futures. And then there was a dramatic drop in the crude oil futures prices here. And so therefore what happened was that what did I say? I don't remember. I made a mistake. I got confused between selling short and buying. So the underlying position for this company, MG Refining, was short oil. Okay, short oil and oil derivatives. The underlying position was short because they had contracted to sell oil and deliver oil to, it was a refining company actually, MG Refining. They had refining operations, oil refining operations. So they had undertaken to sell all kinds of oil and oil derivatives to many, many customers. So they were, underlying position was short because they had contracted to sell. So the short underlying position was sought to be hedged by a long futures position. So the hedge was a long hedge in futures. And then what happened, the futures contract prices started dropping quite dramatically. So the long futures hedges were showing large losses. Okay. And at the same time, the problem that I told you is, unfortunately, their underlying position losses were underlying position were showing some gains, not exactly the same amount, but they were showing gains, but it was unrealized gains. But these cash losses on the futures had to be paid. So eventually these guys ran out of cash because the cash drain was massive in terms of the margin payments on the futures losses. So eventually these guys had to close out the hedge. Okay, and it was a total disaster. Actually, it was a big mess. They had to close out the hedge. And eventually this company went bankrupt. This was a US subsidiary of a German company called a very big German company, kind of like the Tata Group or somebody like that, very big. And this thing had to declare bankruptcy, this unit, the US unit. So this is, I'll share the case with you. But this is the point. The point here to understand is that although in a static hedging program, we came to the discussion here because it's a very important thing to understand that be alert for cash flow differences. That's why these are different instruments. Why are futures different from forwards? Forwards are different from swaps. Swaps are different from options. Why are these different? Because these are different instruments. So they have different instruments means essentially these are different contracts. Okay. So the contract terms are different, and that's what makes them behave in different ways, right? So therefore, it gives them certain different properties. Of course, these are standardized contract terms, but they're all different. So therefore, basically, so why did we come to the discussion that if you have, depending on the kind of instrument that you're using for hedging, there could be cash flow differences between the gains and losses. Cash flow differences mean that one is unrealized, one is realized on the underlying position and the hedge position. So this could mean that this policy, which I've written down here, in practice, you may not be able to follow this policy because you run out of cash. Okay, and that can sometimes create big problems. And we should write the Mexico story here also. And this is why no need to worry about punctuation. Many hedgers use simple long option based hedges. Okay, so if your underlying position is long, you will go long put options. If your underlying position is short, you will go long call options. Okay.
Mexico runs a very wide hedging program because their underlying position is net long, and their revenue also depends on the sale of this commodity. But sir, if their underlying position had it been net short, would it be also prudent for them to use this kind of extensive hedging program?
Yeah, I mean, if you look at India, for instance, India's underlying position is net short, okay, and in that sense, well, we don't normally say net on the case of underlying position. We just say short because it's like a gross position, and then the net is applied to discuss the net of the underlying position and the hedge position. So if you look at India, India is kind of almost on the other side of Mexico because we are short. Our underlying position is short, and we are also, I mean, oil imports are also quite critical to our whole functioning of the government and the budget, because many times, as I told you, we have had dramatic fluctuations in the total dollar payments for oil imports. Because see, the amount of oil you need to run your economy, that can't just because oil prices have gone up, you can't say that, okay, I'm not going to consume the oil. You are going to need pretty much around that amount of oil. Maybe you can cut a little bit here and there, but what therefore happens is you just have to pay up. Whatever the market price is, you have to pay up. And so therefore the oil import bill can fluctuate dramatically. I gave you an example. I was studying this for a few years. And in one year it was 64 billion, and the other year it was 150 billion, 148 billion. So that's the kind of fluctuation in the total oil import bill. So I think certainly that it makes sense for India also, because if you see that kind of fluctuation in the oil import, what happens to that? Now you see, you just had the budget and all going on. Now this what? So all the other expense, because oil is king. Okay, so you got to pay for the oil first. If you had thought about doing some kind of whatever road building somewhere in Arunachal Pradesh, you have to say bye bye to that because you don't have the money, because all the money has gone to pay for the oil. Because you did, although you did budget for that road building, now your budgeted expenditure goes for a toss because something as critical as oil has to be purchased. So if you could cover this risk by strategically buying some options, and if you apply your mind to hedging India's oil exposure, okay, the Mexicans have been doing it for a very long time, and they're very sophisticated. We tend to think of Mexico, we don't think of it as a highly developed country like the US or France or something, but they're actually very sophisticated as hedgers. Okay, I'll explain to you why. But so a short answer to your question, Siddharth, is absolutely it makes sense. Before we come to Ketan, we'll just ask Siddharth if he is satisfied. So in India's example, India is a good example of what Siddharth is talking about. And I think it absolutely makes sense to spend a lot of money because you're spending a lot of money to buy it anyway, right? Your oil import bill is quite high. So Siddharth, are you satisfied with the answer to your question?
Yes, sir. Sir, I was asking this because they are generally also criticized for a huge amount of premium that they pay for these hedging.
You're
I know it makes a lot of sense to do a hedge, but sir, they are also criticized for the premium that they pay.
for the PNL?
Premium that they pay on these hedges.
Yeah, but those are stupid. Those are stupid criticisms. See, we don't have any shortage of stupid people in our country talking about policy. No, these kind of things. This is why we make and why should we listen to these stupid people? Premium, obviously. So why Mexico is paying more than $1 billion a year on? So what? Nobody criticizes the Mexican finance minister. Mexicans have been, and they have been doing this. Even though this is why I say Mexicans are very sophisticated as hedgers, because you notice there was a change in government. AMLO came to power recently. Okay, he's a socialist. He's supposed to be. He calls himself a socialist, but there is no change in the hedging program. And so governments come and governments go. BJP comes and Congress comes and whatever in Mexico, but the hedging program does not change. So it's a very sophisticated program, and I will tell you. But they are paying more than $1 billion every year to hedge. But that is there is a value to that. You have to understand that there is a value to that. What is the value? Let me write it here. Okay. What is the value to that? Okay, this is why many hedgers use simple long option-based hedges to cover risk. This has the advantage. Remember, this is very much in line with the ethos and the philosophy of a hedger. Okay, what is the ethos of a hedger? Not to make money. to bring certainty to cash flows so that the underlying business, which is focused on extracting the efficiencies from the value chain, okay, and locking in operating margins, the underlying business can be protected from needless financial losses. And basically we're trying to lock down the downside, and for that we give up the upside. That's fine. If I can lock in 20-25% margins in my operating margins, then fine, I'm happy to give up some upside, because if you try to stay open for the upside, you might end up with downside, right? So therefore, so this is the advantage of, one sec, this has the advantage of providing certainty to cash flow. This is very important from a hedger's point of view. Many companies, including many well-known, many well-known and big public companies in India, don't even understand these principles. They hedge, they actually speculate while they're hedging. Their treasuries are run without all these principles. It's a real disaster, actually. It's a total governance disaster. This has the advantage of providing certainty to cash flow. Do you understand this, guys, everybody? That if Mexico buys, so for instance, example, let's say, take the example of Mexico, okay? Mexico spends $1 billion to buy oil put options, okay, as hedge position, because Mexico's underlying position is long oil, okay? They've been having some production problems and all those things, but they're still a reasonably big producer. And so if oil prices drop, they are going to suffer. If oil prices drop, they're going to suffer in terms of the sales revenues of Pemex, Petróleos Mexicanos. Then what the idea here is that the oil put options that they have bought as a hedge position, when the oil price drops, the put options will show a profit. So the hedge position profit will offset the losses on the underlying position, okay? So, and now of course they don't buy it on this particular market, okay? They buy it on a underlying market which is slightly different. Of course, it will be connected to West Texas. They buy it on something called the Mexican crude cocktail, which is a cocktail here means a mix of various grades of crude oil, okay? Whatever the grade that the Mexicans are producing, so they try to match. The idea here is to basically reduce the basis risk. We'll come to that, okay? They try to match the position. So that means essentially it's like the underlying basket is actually the Mexican crude oil basket, Mexican crude cocktail. The idea here is very similar to an airline company which has exposure in jet fuel, which is underlying position is short jet fuel for any airline. And the airline says, I don't want to hedge in crude oil because sometimes there may be a difference between the movement of crude oil and the movement of jet fuel. So can you give me a hedge in jet fuel itself? It's talking to a banker. So this is the same kind of thinking that Mexico has when they buy it on the underlying, the basket on which they buy the put options is the Mexican crude cocktail, which reflects the Mexican production mix rather than the West Texas Intermediate. But there is a trade-off here as well. There's a trade-off between liquidity and effectiveness, which we'll come to when we discuss basis risk. Okay, but this is point. So let's look at this example. It spends $1 billion to buy oil put options. Yeah, we're coming to Ketan. Yeah, one sec. What was I answering here? I was answering something else that Mexico was oh yeah, okay. So yeah, and I'll mention one more thing. So the premium outlay should not be seen. That's a stupid criticism, that so that I'm not saying Siddharth is saying something stupid, but Siddharth is only talking about what actually happens in the real world. But I'm telling you that whatever happens if somebody says that in the real world, which is quite common in India, people in the Indian parliament say these kind of things. And not just in the parliament, in the media and other places. But these are stupid criticisms. That means these people don't understand the objective of hedging. Okay? You are providing, here Mexico is providing certainty to cash flow. Notice one more thing. When they buy oil put options, they don't have the fluctuations that will happen in a futures hedge position. They know they spend $1 billion, they bought the put options, now they can sit quietly. Okay, there is no further cash flow movement happening. This is another great advantage because it reduces your headaches as a hedger. managing the hedge position. So this is one point, okay? And I will explain the sophistication of the Mexican hedging program. Let's put this way. I want to write about this. This is a very important point. They are very sophisticated. I will mention this. I think you need to understand this. This is something where we are lacking because we and India, especially the Indian government, again, it is not a matter of BJP or Congress. They're all the same. They all seem to be socialists. They don't understand, and especially when it comes to hedging, they don't understand these points. The point that Siddharth is making is a very valid point because Siddharth is reflecting the reality of the Indian discussion around these issues. We have people asking these stupid questions, and nobody even says that they are stupid questions. People ask these questions, and people are actually seriously trying to answer these questions. Okay, I'm not criticizing Siddharth, but anyway, okay, let's go to Ketan. So Siddharth, you're happy with the resolution, with your answers?
Yes, sir.
Okay. Now, Ketan, what is your question?
Like government hedges for commodities like oil and gold, but they also do hedge for currencies. Like I read previously that India is hedging for their currency in the US market.
Yeah, I mean, I don't know what exactly. You can send me the article wherever you read it. You can send it to me, then we can discuss that in more specific terms. Okay. But currency hedges in the sense that, we are going to, our Reserve Bank has the ability to print an unlimited amount of rupees. Okay. But yeah, so India can also similarly hedge currencies. There's no problem with that. I'm not aware of a particular example where they did that. But they can also similarly hedge currencies, okay, where they have, let's say, for instance, there has to be, remember, if you're hedging, one thing you should always remember, Ketan and everybody else, okay, I don't know which press article you read, you should send it to me, because sometimes people in the press use the word hedging in a very casual way, okay. Remember one thing, you cannot hedge unless there is a underlying position. The hedge is only defined if you have an underlying position, okay, because the hedge is the offset to the underlying position. You can't say, okay, if Utsav goes and buys some GameStop shares and then he sells them off, then you don't say that Utsav is hedging his GameStop shares because he's just squaring his underlying position. Or if he goes short initially, you don't say that he's hedging. He's just speculating, okay? There is no underlying position to start with. So in order to be a hedger, you have to first have an underlying position, which usually comes from the nature of your business or your activity. Yes. First, let's see if Shaurya will come to you. First, Ketan, are you satisfied with the answer to your question? It is possible.
Yes, sir. I will look for the article and send it mail.
Yeah. So I'll just tell you one more thing, that it is possible for India to hedge where you need to first have an underlying position. Okay. So let's put it this way. Let's answer this also. So for instance, India can also hedge FX. We are using FX as shorthand for currencies, FX risk, but there should be an. So what could be an example of an underlying position? Okay, let's say a 100 billion CHF amount. Let's say the amount CHF, okay? CHF is Swiss franc, okay? 100 billion CHF loan maturing 10 years.
Yes, sir. Yes, sir. Sir, my question was that.
1 minute.
So
sorry.
we need at least two.
I'll
Okay.
come. Let me just finish this part. It's partly the answer to Ketan's question. I'll just finish this, then I'll come to you. One sec. Example: 100 million CHF loan India has taken. Okay. GOI. Okay. The government of India has a 100 billion CHF loan maturing 10 years from today. And lender is the IMF, okay? The International Monetary Fund lent us 100 billion CHF. maturing 10 years from today. Okay, so now this is the exposure that the government has. So the this is your underlying position. The point I'm trying to emphasize: don't lose this theoretical clarity, because in the markets also people might use the word hedge casually. There cannot be a hedge without an underlying position. Period. Okay. So if you're talking about hedging, first identify what is the underlying position. There has to be a specific underlying position. Like Government of India has a loan from the IMF. Repayment is 10 years from today. Amount is 100 million Swiss, 100 billion Swiss. Okay. So the government has to repay in 10 years. It is short 100 billion Swiss francs, and it is long the amount of rupees at which the loan was, which is basically at the Swiss franc rupee rate, which prevailed at the time the loan was disbursed. Because go back and see when the loan is disbursed by the IMF, what happens? IMF pays 100 billion Swiss francs into India's, let's make this 100 billion loan is a little bit too much. Let's reduce the amount of money. Okay. All right. So this IMF pays, India has a, GOI maintains a Swiss franc account, okay, with UBS, Zurich, or whoever. It'll be somewhere in Switzerland. So GOI will maintain a Swiss bank account with this will be a Swiss Nostro, Reserve Bank of RBI will maintain it with UBS Zurich, let's say. And so IMF is going to transfer the 100 million Swiss franc into RBI's account in Zurich, so with UBS Zurich. Then RBI will sell this Swiss franc in the local currency market to some banks in the Indian market, okay? Or generally they'll have to sell it because the other side is rupees. And RBI will receive rupees in return. So RBI will sell Swiss franc and get buy rupees. And that rupee the RBI will send to the Government of India, which the government will use for all kinds of spending, okay? Now this happiness will go on for 10 years, and after 10 years you will have to pay back. So if you take the loan, you have to understand that when you say that India is short 100 million Swiss franc 10 years forward, okay? And it is short Swiss and it is long rupees. At which rate? At what rate? It will be the rate at which the RBI converted that 100 million Swiss into Indian rupees. Okay? That has to be the rate. So when you write down your exposure as the manager of RBI's foreign exchange risks or India's foreign exchange risks, you have to write down your underlying exposure as follows. Short 100 million Swiss, long equivalent rupees, maturity date 10 years from today, and equivalent rupees is to be arrived at by converting 100 million Swiss at the rate which RBI used to convert the Swiss franc rate into the Swiss franc proceeds into Indian rupees in the local market. That may be an average rate of weighted average rate of many transactions. Are you following so far, everybody? We'll come to Shaurya. Are you following so far, everyone?
Yes, sir.
Okay.
Yes.
Yes, sir.
Okay. So that's your underlying position. Always remember, cannot be any hedge. There cannot be any hedge without an underlying position. So now what Ketan is saying, this might have happened. I'm not aware of the story. He'll send me the story. But in a situation like this, there can be a hedge of FX risk when the RBI might decide it's not looking so good. I think the Swiss franc is going to get very strong. We better hedge our exposure. So the RBI might go into the local market and start dealing with banks and start buying Swiss francs and selling rupees as a hedge against this underlying exposure. Okay? So that might happen. Is this clear, Ketan? Are you following what I'm saying?
Yes, sir, but the question was my different.
What was the question?
Sir, once again, I'm sending you the news article.
The article we'll discuss it. Okay, now let's go to Shaurya. I think now at least you have understood, right? At least you have understood.
Yes, sir, I understood the basics.
Yeah, how India would hedge FX risk on a currency, on a foreign currency loan. That's one. So, okay, Shaurya, what is your question?
My question was that for hedging to take place, there should be at least two assets, right? At least.
So for any transaction in a market, there have to be two assets. No, there is no market without two assets.
So, for example, you sir told us, for example, one asset was bought, for example, that GameStop stock, and then if it is sold off because the trend is going slightly downward, so it will not be called hedging. But if I buy one GameStop stock and then some other asset that against GameStop, to manage out the losses, then it would be called hedging.
No. You have not understood. One second. What is the when you trade in GameStop? What is the other asset? This is the market, right? This is the market for GameStop shares. What is the other asset?
Some other kind of stock that would be against some, not against, like a correlationally inversely correlated, something like some other kind of stock.
This is like you're reminding me, like in this is very basic stuff. Please remember, please understand. When you're trading in GameStop shares, what is this? This 200, whatever the price is now. Yesterday's 225. What is this 225 Swiss francs? What is this 225? One share of GameStop is 220. GameStop is 225. What is it? Swiss francs? Japanese yen? What is it?
Dollars.
So that means your other asset in this market is US dollars. I don't know what question you're asking, but it seemed to me that you were not clear about this part, that the other asset is US dollars. In any market, there are always two assets. You go to the Gazipur Mandi. Of course, I would not recommend going to the Gazipur Mandi right now in this situation. We go to the Gazipur Mandi and buy 10 quintals of sugar. What is the other asset? Yes?
The cash.
Cash. Don't say cash, say Indian rupees.
Indian rupees.
Yeah. So please, so therefore, please understand. In any market, if I just give you, if I just give you 100 million rupees, that's not a transaction as such. I mean, unless you give me, you record a loan or something like that as such. If it's just a transfer, it's not really a transaction. Okay, it's not a market transaction. There has to be an exchange of assets. If I lend you the money, then you will give me a debt instrument saying Shaurya owes 100 million rupees to Ram. And that's my bond, that's my debt instrument, which can be a negotiable instrument. I can sell it in the market to other people. And that is basically an IOU written by Shaurya saying I will pay 100 million rupees to the holder of this instrument. That's a transaction. That's a market transaction. But if I just transfer 100 million rupees from my account to yours, there's no market transaction because there is no two assets involved. I'm just transferring my money to you. Got it?
Yes, sir. So, okay, sir.
In every market transaction, there are always two assets. Excuse the sounds, okay? So in every market transaction, there are always two assets. So I don't know what was your confusion. That there is the reason I said.
I meant one instrument is for that asset, and another one is like betting against it. That's what I meant by two assets. Actually, I didn't consider the dollar or the currency factor. Actually,
You
when I
have
explained that question.
very basic stuff. This I'm noticing with respect to you, Shaurya. I've noticed this. I think you're not spending enough time reading the notes and absorbing the basic concept. Because when I see you, the questions you ask, I'm not blaming you for asking the questions. They reflect that you are not. That means your basic concepts you have not spent enough time reading and thinking about it. Because you have basic confusions at the basic level that you don't know. For instance, this thing. Okay, you should not feel embarrassed that we are discussing in front of the whole class. But I'm just pointing out the weakness, a mistake that you're making for some reason. You are not clarifying the basic. Your basic concepts are not clear. I think because you're not spending enough time reading. That is my assessment. I think you need to step up your effort levels because I think from the questions you asked, my assessment is that you're not spending enough time reading. Is this clear? Yes, Shaurya?
Yes, sir.
Okay, I hope you're not offended.
Yes, sir.
But it is something that there's no opportunity for me to tell you otherwise. But this way we are warning to other people also that they should also, everybody should spend more time reading the notes. I think you're not spending enough time studying. Okay. All right. So we'll try to move on now. Are you satisfied, Shaurya, with any other question? Have you understood this point?
No, I understood, sir.
Yeah. So the reason I said when Utsav buys GameStop here, then he sells it off at 400. He's not hedging because he's only squaring his long position. He was a speculator to start with. He didn't have any underlying position. He had some cash in his account. He went to the Reddit forums and then he bought the stock and saw it go up, and then he sold his stock and realized his profits. Simple. Is in and out. Okay, there is no hedging involved here. Squaring your speculative long position is not a hedge. Okay, so this is the situation. So what we have learned here is that India can also, that there's etc. So we discussed this situation. Okay. And okay, now I just wanted to mention one more point about the Mexican hedging program, which is very important. I think it's important to understand that as a refined understanding of hedging. Now, why do I say the Mexicans are very sophisticated hedgers? Okay, now if you see when the oil price was here, I remember there's a particular time of year when they come into the market and they start to look for. Okay, let's look at oil. Yeah. So I remember the story around here. Okay, if we look at, so it makes sense to look at the long-term chart. You see where we are in the long-term price action. So I remember around here, around 35. Yeah, this story I remember. So I think they start around the end of the year, around the new year, around this time they start looking for prices in the OTC markets. So they talk to the dealers in the OTC market, and then the word gets around because the OTC market is not transparent. So you kind of hear, oh, I hear that they're shopping around for prices and stuff. So now imagine this, that prices, Mexico is an oil producer. They have seen prices going to 140, then even 120, and now it is down to 35. Now, typically what would have happened if you look at the quality of decision making that happens in India at the policy level, again, irrespective of political party, we seem to be just constantly not very wise about these things. In India, people will say things like, oh no, it's not going to go down anymore. It's just okay, now it will go up. We actually had Arvind Subramaniam, who was our chief economic advisor around this time. He was saying that, oh, oil prices won't go beyond $45. I mean, it's astounding, that somebody can make a statement as stupid as that. It just reflects that these guys have never traded anything in their lives. Anybody who has any real life trading exposure will never make a stupid statement like this, that oil price will not go beyond 2045. There is no basis for making these kind of statements because nobody knows what will happen. It can go to anything. As it happened, it went very quickly to $75, $80. Okay, so nobody should ever. Whenever you see somebody making these kind of statements, you should identify them as an idiot because they don't have. These are the kind of people who make these statements are people who have never traded in their lives. They never had any real positions. Okay, so this is now. Notice this. In India, we would have been talking like this, and the Mexicans went and put on their full hedges at $35. Do you imagine? Can you imagine how it feels as an oil producer to be hedging at $35 with this kind of long-term price history? Do you understand what I'm trying to say, guys? Can you understand what I'm trying to say here? This is what you call a sophisticated hedging program. That means they understand that even at 35, it can go lower. As it happened, it went only up to about 25 and then bounced. Okay, but later on, it did go so far below, right? So the point is, the reason I'm saying the Mexicans are very sophisticated hedgers is that even at 35, they didn't do any crying, ow, ow, and all, you don't want to hedge at this price. They just smoothly went and hedged their full production or whatever amount they usually hedge at $35, okay? Because they know that it can go below 35. You had a period in the oil market when prices were so low for so long. How do you know that this is not going to enter that kind of a period again? Nobody knows. There is no basis for saying things like the oil price will not go above $45. There's no basis for making any kind of definite statements about what will happen in the market because nobody knows. Okay, anything can happen. You can go into this kind of a prolonged depression in oil prices, and it can happen at any point of time. So that's why I say that Mexicans are very sophisticated hedgers because they were not like crybabies at that price. I hope you understand what it means that in terms of an oil producer who has seen prices at 120 and 140, etc., now they're hedging at almost at historic lows at $35, and they're still putting on billions of dollars in long oil put options to hedge their production. You can understand, basically going back to what Siddharth was saying, you can understand why this is not an easy thing to do. Do you understand that, Siddharth? Let's ask Siddharth, for instance.
Yes, sir. But is it a dynamic hedging program or static?
That I don't know. We need some inside info to figure that out. But I would suspect that it is static. That is my suspicion.
Yes, sir. Because when they buy these put options, a news comes in, and also the estimated figure also comes in for that, and it's one time in a year.
Sir, why not dynamic?
So you are on mute.
I'm on mute, right? Okay. So I wanted to ask, okay, so I wanted to make sure that people have understood what I meant by a very sophisticated hedging program. We are running out of time, so we won't ask any questions. Okay, so I hope you understand this. This is an important thing to understand, actually, that uh, this shows the sophistication of the hedging program because it shows understanding that anything can happen, that prices could go and become depressed like this at low levels. So even at 35, it makes sense for a producer to hedge against further downside. This kind of thinking will be very difficult for India to achieve. I mean, I don't see this kind of sophisticated thinking coming in the Indian policy making sphere. If it comes, I'll be damn happy because, it means that we are moving forward as a country, because right now we are still stuck. So, for instance, the opposite of this, what happened in India was I've mentioned the point to you about. You can read through that. We had a collar kind of transaction with Qatar for buying gas, connected, I think, to the oil price. We don't have good information on this because all government stuff. But then, as oil prices fell below the lower part of the floor, we were still buying at 36, at 35, and the oil prices were at 25. People started saying the kind of things that Siddharth is reporting on, that people started saying stupid things like, why are you buying at 35 when the market is at 25? These people should understand that these transactions are not done for today. They're done for long-term periods to bring certainty to cash flows. Today it is at 25, tomorrow it will shoot up to 79, then what will you say? Because your collar also gave you protection above, say, 45. So you're buying between 35 and 45. You only pay between 35 and 45. And if it goes below 35, you still pay 35. If it goes above 45, you still pay only 45. But now our over smart people who are managing the program, they unwound that hedge. And they said, no, it's gone below 35. We could have been buying at 25. Let's unwind this hedging structure. So then when it went above 45 to 75, now they were paying 75. So these are the kind of over smart people with very short-term horizons. This is real stupidity in terms of when it comes to thinking like a hedger. This is what you call real stupidity, okay? So I want you to understand these things. And I was just trying to check whether people understood what I was saying. So I was asking Janvi, did you understand the meaning of what I was talking about so far? Why I'm saying the Mexicans are sophisticated hedgers? Now we'll find out if Janvi is sleeping or not.
Yes, sir. Yes, sir.
You understood?
So, like not that properly, but I will watch this session once again. But I sort of understood, but I need to watch this session once again.
Yeah. Please make sure you understand this, because we in India, in our country, we actually have this problem. People need to understand that what is the objective of hedging, and that if you are trying to get advantage on one side, then tomorrow when the tide turns, you have lost your hedge, you don't have the cover on the other side. So this idea of hedging as objective of hedging being to bring certainty to cash flows, long-term, medium-term cash flows, and not to make profits. This thing has to be understood, okay? and why these Mexicans are very sophisticated hedgers. It will give you a good sense of hedging. This will be useful even in your corporate life if you have encountered this kind of a situation. So we have spent a lot of time on this today, but I think these are all important questions which you need to understand. And one of our problems in the program is we don't have enough time. I only have 30 sessions, 60 sessions with you guys to explain all these aspects of finance, which is not at all adequate. But we'll do whatever we can, and then we can talk even after the course is over, even after the MBA program is over. Okay, so let's try to understand this further. We are, I think, running out of time, but let's try to understand this further. Okay, so this is one thing we have understood about the static hedging programs and many of the problems. Okay, sophisticated hedgers, you have understood why. Okay. Now, in the dynamic hedging program, the difference, we have already explained this, so I won't cover this anymore later on, other than to go through the notes. Okay. So in a dynamic hedging program, you can repeatedly hedge and unhedge the position. So if you are India, let's say, and you have you've got put out long hedges over here, and the oil price shoots up. Okay, so your underlying position oil import bill has gone up, but your hedge position is showing a huge profit. At this point, you feel that the price is likely to drop. So in a dynamic hedging program, you have a long hedge. You will sell the long hedge and go to zero hedge. And then the market will drop. And then again, you'll try to buy it before the market shoots up. We have discussed this before. So please read this. 1 minute. Okay, so I'm protecting your lunch by closing the class on time. So the class is dismissed. You can read, please make sure you read this. And everybody, whoever, please watch the session again and make sure you understand all the points that are being made here. Okay, and read the session on a little part of dynamic hedging. So we won't cover this anymore in the next class. Okay, so this is basically what it means, that in dynamic hedging, you can hedge and unhedge parts or whole of the underlying position, and based on your view on what's going to happen to the market. And of course, that can have negative consequences also. It's not that always you're going to be able to catch all the twists and turns. So that's the basic difference between hedging and dynamic hedging and static hedging programs. And we had some discussions on market stories. Okay, so class is dismissed. I have taken, I've taken 1 minute extra free. Okay, so you guys can go. And so some of these people who need new accounts should stay back. Vipul and Ketan, I will give them accounts. But does anybody have a conceptual question at this stage? Before then, I stop the recording at that point.
Yes, sir, I have.
Yeah, yes, Shrishti, what is the question?
Yes, sir, I have a question.
Yeah.
Sir, I was confused between the programs Mexico is having. I think they are following the static hedging program because Siddharth mentioned that they hedge it once a year only.
Yeah. So,
that's the reason which gives us the answer that they are following the static hedging program. So am I correct?
Yeah, I suspect you are correct. Actually, you have muted yourself. But you're correct. I suspect you're correct. And as I said, now see, this information on Mexico is it's not publicly available freely. There are some articles here and there, but they don't it's not like the government of Mexico is transmitting this information freely. So therefore, we need to find out by needing news reports. But I would also suspect that it is a static hedging program. Why? Because they are usually operating in the OTC markets. Okay, there are many reasons why I'm saying this. Okay, and the underlying reference, spelling is all over the place, underlying reference asset, okay, for these, excuse the caps, easy, for these options is the Mexican crude cocktail, okay, which is not a very liquid underlying asset, okay. If you say Mexican crude cocktail, which means basically the Mexican crude cocktail is meant to reflect the production mix of Pemex. whatever Pemex is producing, Petróleos Mexicanos, that is sought to be reflected in the Mexican crude cocktail. And so the options are against the underlying asset being Mexican crude cocktail as opposed to something like West Texas Intermediate. Now, obviously, if you buy options on West Texas Intermediate, these are going to be much more liquid because this is a very actively traded market. So this is not. So there are many reasons why I would tend to agree with Siddharth and Srishti that these are static hedging programs, although I don't have direct information on that. But I would suspect these are because they are in OTC markets, and the underlying reference asset for these options is the Mexican crude cocktail, which is not a liquid market like WTI or Brent. Okay, so generally remember one thing, that if you are actually doing a dynamic hedging program, that requires you to hedge and unhedge, hedge here, unhedge here, let it drop, then hedge again, go here, unhedge it here, and then let it drop and hedge it again, go. So it requires you to trade in and out many, many times, okay? And this is just a big chart. You can do it many times a day as well. So therefore, it requires a very liquid market. And the OTC market for these kinds of products is not that liquid, okay? It's not like you're trading OTC foreign exchange, which is very, very liquid. So these markets, they are doing it in the OTC markets. And therefore, these are all the reasons why the point here is that this is a separate product. This is a separate point, okay? Plus OTC markets forget the spelling here, are not that liquid, okay? And the point is, and a dynamic hedging program requires liquid markets, okay? Otherwise, it doesn't make sense. If you're running a dynamic hedging program, you need to be operating in liquid markets. So if your hedging instrument is if your hedging instrument is West Texas Intermediate crude oil futures or Brent crude oil futures, then it makes sense to run a dynamic hedging program because these markets are very liquid, these futures markets. But if your hedging instrument is OTC oil put options on the underlying reference asset of the Mexican crude cocktail, this is not a liquid market. That much I can tell you without having any information, inside information to the Mexican government. From the knowledge of markets, I can tell you this is not a liquid market, and so therefore I would not expect them to be running a dynamic hedging program when the market is not that liquid. Okay, so that is the answer. So does that make sense to you? Does that answer your question, Srishti?
Yes, sir.
Okay, and Siddharth also is this also answers some of your questions.
Yes, sir.
Yeah, and if you have anything, Siddharth, whatever notes you have, Siddharth, Srishti, if you come across any articles on this, please send it to me. I'm very curious about this program. I haven't had time to search, for too many things. If you get anything on this, just please send it to me if you find any articles. Okay. All right. Any other?
Sir, I read some.
Sorry.
Sir, I read a paper on it, but sir, it was it was actually simplistic rather than being simple. So it was not a good. It only explained a few things that you already told us, but sir, not in detail. The information is not much out there about the amounts and about the time at which they do this.
Okay, no problem. Yeah, whatever you get, you can just forward it to me. It'll be I can just look at it. Okay. Anything else, guys? Anybody else have a conceptual question?
Sir, I had
yes,
another
sir.
question.
Yes, Srishti, go ahead. Oh, Srishti, you have to also, as part of the administrative discussions, you can go ahead with a question now, but you also have to discuss the scheduling of a tutorial or something like another tutorial session for other doubt clarifications and all that. Yeah, go ahead with your question now, Srishti.
Sir, I was saying that as we as you told that in MG refining case, company was short when it promised the delivery of oil to the firms or whatever the companies were there. So it was short, but it must be having a long position in oil in the first place, no? Because it was an oil refining company.
Okay, that's a very good question. Yeah, so
So
it was, but they had certain many in the sense that they had the hedges that they had put on. They had some oil refining like, operations as well, but the hedges that they had put on for I mean the sales that they had made in the underlying markets were for amounts greater than the refining capacity that they had. Okay, so that's why it is for the balance that they had. So I did not clarify this. It's a very good question actually, that those were for the balance exposure that they had. So like if you have sold 100 million barrels of oil in the OTC markets to customers, and your production capacity is only say 30 million barrels. So for the 70 million balanced barrels, you still need to come up with a hedge, because otherwise you're net short 70 million barrels. This is clear? Yeah, but it's a very good question actually. That shows a very good understanding of what was being discussed. Yeah, so I got that. So I got that. So yeah. So whatever you get, you just send it to me. I'm very curious about all this information. So I will just pick up whatever comes. Yeah. So, Srishti, does that answer your question?
yes, sir, that answers my question. So, sir, I was saying that for the remaining 17 million barrels, they should have gone short because their position was long.
No. See,
But because they had already contracted for 13 million barrels, they went long for all the 30 million barrels.
yeah, Kritika, I will come to you. Those capstone projects and all are basically are part of administrative discussions. So I'm first, because I'm recording this still. That's why I'm finishing off the conceptual questions first. Yeah. So
Okay, sir.
so the point is like this, that if we have in the case of MG, okay, so their underlying position will be short 100 million, okay, and as a natural hedge they have only say 30 million of production capacity. For now this 100 million short, they have sold long-term contracts, oil supply contracts, oil and oil derivative supply contracts to customers in the market, to gas stations and things like that. So this is your coming from the trade, the business you're doing. You have a natural refining capacity of 30 million, but you still have a total net position of short of minus 70. Okay, so therefore for this amount you have to put on futures hedges, because here if the oil price goes up, you may have contracted at a certain price. Maybe you're selling it to, your sales are at around say $50 per barrel. But if the oil price shoots up to $75 a barrel, then you'll be selling at $50 and buying at $75. So then you'll be making losses. So you still need a hedge position for 70 million barrels. Is this clear, Srishti? Does it clarify your doubt?
Yes, sir, I'll think about it more. Actually, I'm not able to grasp everything. Like, I think I asked something else.
Yeah. So it's basically this, that your underlying position, your point is very correct. That is very good that you grasp that if you have made sales to gas stations, if you have committed to gas stations to sell them 100 million barrels of oil or kerosene or whatever, or whatever, gasoline and stuff like that, oil derivatives, and your refinery only produces 30 million barrels. So 30 million will hedge this natural long position in the refinery, will hedge their if you have basically not just the refinery, but you have to have the production access also. Okay, and if you have that, then this will cover only 30 this amount, but the balance is still there, has to be covered. No? So that is why you need to hedge, and that is what they had done actually. Wherever they did not have, basically you need to have the production. It's just not sufficient to have a refinery. You need to have the production assets. because it goes from production, exploration and production, and then on to refining. If you are just holding a refinery, you're still short because you need to buy the oil even in the refinery. The refining only gives you having the refinery only gives you the capacity to turn crude oil into gasoline and kerosene and all these kind of things, or jet fuel, which is basically like kerosene. Are you getting the point, Srishti? So you have to look at your natural business. If there is any offsetting hedge in the natural business, but is that actually a long position, a net long position in crude oil? Because if you only have a refinery, you don't really have a long position in crude oil. This 30 million has to be production assets. Your ability to produce and to dig out 30 million barrels of oil from the ground. Is this clear?
Yes, sir. So the company should hedge according to the current position it has in the market. If
Yeah.
it has a short position, it should just reverse the position. We should not just reverse the position for the whole quantity we have.
Yeah, whatever is your net, you underlying, see what you've done in the trade, in the business, and that leads to underlying positions. And then you see if you have a natural hedge in the other way. So if you have production assets of 30 million barrels, then it's fine. You don't have to hedge 100 million short. You have to only hedge the 70 million short barrels. Is this clear? But these have to be production assets. Refining, having a refinery is not good enough because that's not a net long position in crude oil. That is just a refinery. Because the refinery still needs to buy the input and produce then only it can produce the output. So it is still net short crude oil. But this has to be production assets. This 30 we can only write here if we have production assets. Is this clear?
Yes, sir.
Right? They have to understand this part. Okay. Any other conceptual question? I think what we'll do, Srishti, is if you have any other question, we'll leave it for the tutorial session because I think the other guys are getting restless.
Yes, sir. Yes, sir.
Yeah. So we'll stop this, and then you can stay back if you want. You can scheduling your session. Okay. All right. Now let's talk to yes, Ketan. You had raised your hand.
Yes, sir. I was saying the same. Actually, I have to go somewhere. So
Yeah. Okay. So let's talk about sessions. No, Ketan has. You need to do. We'll come to. So let's do. Let's Kritika and Shresh. We need to discuss your. We'll come to Siddharth. Let's first deal with Kritika because she sent a message earlier.
Yes, sir.
So Kritika, you need to. What do we need to do? We need to have a session, right, on Zoom.
As you say, sir.
You guys have decided some topic.
Yes, sir. I sent you the mail earlier.
Oh yeah. You gave me 5 topics because I'm getting so many mails.
Yes, sir. You selected one for us and you told us to stay back after the class.
Yeah. So we can schedule a meeting. Let me see what is due actually when all kinds of stuff. So Vacha, tell me what is this? Let me first understand this capstone business. It's so confusing actually. This capstone project now this term has become very confusing. Are you guys finding it confusing? This teaming up.
sir, very much.
Sir, yes, sir.
Yes, sir.
Yes, sir.
It's good to know that you guys are also finding it confusing because I am also confused. So it is that everybody's confused. That is good. So, okay. So capstone. Now let's try to understand a few things. Okay. Where is the date business? Okay. Let's try to understand this. When is the final report submission? Do you know the date?
No, sir.
No, sir, it hasn't been notified yet.
It is when?
Sir, the date hasn't been disclosed, but they were saying like there will be 2 midterm draft submissions as well.
Okay. My God, these are all very confusing. Anyway, highly confusing. Okay. So let's do one thing. Let's schedule some meetings quickly, but not before 5th and 6th because I have some submissions between 5th and 6th. So let's randomly schedule some submissions. Okay. Let's schedule some meetings. Let's first give a time to slot to Kritika and Shresh, and then we'll move on to other people. So I don't want to do anything here because we have a lot of activity going on here. Okay. So if we schedule something for like 9th, will it be too late, Kritika?
No, sir. It would be fine.
Okay, so let's put the note. I'll put the dates here itself. So let's do 2/9. I'm going to put it here. Okay. Kritika, I'll just write your name. Okay, Kritika plus. At what time? Let's do. I prefer to do this around 10:30. Is that okay for you guys? It's too late.
So, no issues.
You're okay, right? You didn't seem very comfortable. You're okay. You don't have a problem because I feel more
Sir,
comfortable.
I was confused whether it's AM or PM.
Yeah, PM is okay.
Yes, sir.
Okay, Kritika. Okay, so Kritika can leave now. You have taken big care. Now, who is the other one?
Okay, sir. Thank you.
Who else has? Okay, so I'll send you the Zoom invite for Kritika and Shresh. Okay,
Okay,
next.
sir.
Sir, I just wanted to tell you that I think Gaurav sir has already conveyed you the changes.
Yeah. He was asking for something. I don't even know what he was asking for. I'm so confused. I said, whatever you want, please take it. So I just said yes to whatever he said. So I think, were you also copied on those mails? So whatever you guys were, basically, I did not raise an objection to anything. Okay. And I forgot to.